What's up, guys? This is Manoj Vapani. I welcome you all on behalf of the Edupedia world. It's been a fantastic morning outside, and I'm sure that you guys must be enjoying your life to the fullest. I hope you guys are watching this video in the best of your health and spirit, guys, and surely you guys are dedicatedly devoting your time towards the revision. Remember, guys, CA final is a tough nut to crack. All you need to do is just revise your topics time and again because that is something which is extremely crucial for all of you to understand. Guys, we have been discussing few of the relevant questions which have already been asked in CA final examination relating to the topic of leasing decisions. So by now we have already covered our 6 presentations. 4 were dedicated towards the questions which have already been asked in CA final examinations, and the first 2 presentations were solely dedicated towards the theoretical concepts which you need to understand while solving these questions. This is gonna be my 7th video presentation in which I'm again gonna discuss you 2 of the questions which have already been asked in CA final examinations. Post this presentation, I'll have my final presentation wherein I'll be discussing the remaining questions which have been asked in CA final examination for relating to the topic of leasing decisions. So I hope you guys are bang on, you guys are ready to kickstart. Let's go ahead, fasten up your seatbelts. We're about to take off with the first question of the day, and that will be this. A company is planning to acquire a machine costing rupees 5 lakhs. Effective life of the machine is 5 years. The company is considering 2 options. Number 1, to purchase the machine by lease, or number 2, to borrow rupees 5 lakh from the bankers at 10% per annum interest. The principal amount of loan will be paid in 5 equal installments to be paid annually. The machine will be sold at 50,000 rupees at the end of 5th year. Following further information are also given. Number 1, principal, interest and lease rentals are payable on the last day of each year. Guys, this is something which is extremely important for you to note in your mind. Number 2, the machine will be fully depreciated over its effective life. Number 3, the tax rate is 30% and after tax cost of capital is 8%. Now we are supposed to compute the lease rentals which are payable, which will make the firm indifferent to the loan option. Suppose there is a situation, guys, wherein let's suppose I need to pay the same amount of lease rentals, and if I'll take the loan I have to pay the same amount of installment. Then what should be that particular amount wherein I'll be indifferent to choose any of them? This is what this question is asking us. We need to find out that figure wherein the company will be indifferent to any of the loan option, whether to go for borrowing or to go for lease rentals. This is what we are supposed to perform in this particular question. Now, what it says that the machine costing is of rupees 5 lakh. Either 2 options are available. Either we can lease out on lease rental basis, or we can borrow that 5 lakh rupees from the bankers at 10% per annum interest, and we can pay that rupees 5 lakh in 5 equal installments which are paid annually. Also, we need to remember is that the salvage value of the machinery after the end of 5th year will be rupees 50,000. Principal, interest, lease rentals, all of them are payable at the end of each year. And next will be the taxation rate. So taxation rate in this particular question has been provided to us at 30%, and the after tax cost of capital, which will be used as a discounting factor, that is provided to us in the question as 8%. So are we guys clear with the question? Absolutely we are. Let's move ahead towards the solution in order to understand what kind of presentation that you should give in your examination so as to get 10% marks. Guys, this is the first presentation for borrowing option. Let's suppose had it been the case I am supposed to go for borrowing option, then what will be my present value of the net cash outflows that will happen to my question? Let's understand that first. Number 1, it says that the annual principal repayment installment will be in 5 installments. Clear, guys? 5 lakh rupees is the cost of the machine. 5 is the number of installments that we are supposed to pay. So in each installment I am supposed to pay rupees 1 lakh as principal repayment. Clear? Next, it says that the asset is going to depreciate over its entire life in an effective way, which is the SLM basis. So annual depreciation again, it's gonna be 1 lakh rupees. Why? Because the cost of the asset is 5 lakh and 5 is the useful number of year of life. So 1 lakh will be the annual depreciation. Coming to next part, which is computation of the net cash outflows. Guys, this particular table has been divided into 8 different columns. First column is for year 1, 2, 3, 4, 5. Next column is for principal. Third column is for the interest. Fourth column will be the total amount of principal as well as interest. Fifth column will be tax saving on depreciation or interest, whichever the case may be. Then after evaluating the same, we'll get the figure of net cash outflow after deducting the tax saving of depreciation and interest from the total payment. We'll have to multiply the same with the present value factor, that is 8% for each of the years, and then we'll get the total present value. Remember guys, in this particular question we have been told to us that there is a salvage value of this machine which is 50,000 rupees. So we also need to take into consideration the present value of that salvage value in today's term. So that will also be included in order to reach to the position of calculating the present value for net cash outflows. Are we guys clear with the basic thing? Right. Let's go ahead and understand this table. Now guys, I have made this table into 8 different columns. Year 1, 2, 3, 4, 5. Principal in each of the following cases, it has to remain same, which is 1 lakh rupees. Principal installment repayment will be in each and every case as 1 lakh rupees. 5 lakh divided by 5, which is 1 lakh. Now, since I am paying off the principal on equal basis and the interval is exactly regular, so my interest for the first year is gonna be 50,000 rupees. It has been told to us in the question itself that the person can borrow from the bankers rupees 5 lakh at 10% interest. So on 5 lakh, the interest of 10% is gonna be 50,000 rupees. So which has been mentioned in the first year. Now the total repayment which I am making out in first year, it's gonna be rupees 1 lakh for principal and rupees 50,000 for interest. The total is 1 lakh 50,000. Now since the interest which I am paying off and the depreciation which I am claiming in my books of accounts, both of them are tax deductible expenditures. This is gonna provide me a tax saving. The taxation rate which applies to the company is 30%. So I'll directly multiply 1 lakh rupees depreciation and interest of 50,000 with 30%. I'll get a figure of 45,000 as my tax saving on depreciation and interest. Now, since this is my tax saving, I'll deduct the same from my outflow, which was 1,50,000 in year 1. I'll get a net cash outflow of rupees 1,05,000 rupees. The same has to be multiplied with the present value factor at 8% for year 1, which will be 1 divided by 1.08. It comes out to be 0.926. I'll multiply the same with 1,05,000. I'll get a figure of total present value of cash outflow for year 1 as 97,230 rupees. Clear guys? Perfect. Next comes year 2. Now guys, since I made the principal repayment of 1 lakh rupees in year 1 itself, so what is the principal amount which is outstanding at the end of year 1? It is only 4 lakh rupees. Now, for year 2, the interest will be calculated on that 4 lakh and not on rupees 5 lakh. Clear? It's easy. So 4 lakh multiplied by 10%, which is the interest rate, I'll get a figure of 40,000 rupees as my interest for year number 2. Now, add the same to the principal repayment, which is 1 lakh. You'll get a total cash outflow of rupees 1,40,000. Now, we need to consider the tax saving on depreciation and interest for year number 2. Then the depreciation has to be the same, which is 1 lakh. Adding to it, we'll add the interest, which is 40,000 for year number 2. I'll get a figure of 42,000 once I'll multiply the same with 30% taxation rate. This 42,000 will be deducted from 1,40,000, which was my overall cash outflow. I'll get the net cash outflow, which is 98,000 then. Multiply it with the present value interest rate factor at 8% annuity for year number 2, which is 0.857. You'll get a total present value of the cash outflow for year number 2 as 83,986 rupees. Clear guys? Perfect. Now we need to do the similar exercise for year number 3 as well as year number 4. I'll straight away come to year number 5 in order to make sure that you completely get this point till the last, which will be now, since I've already made the repayments of 4 years, my principal amount outstanding has come and decreased to a figure of 1 lakh now. I've already paid 1 lakh for year 1, 1 lakh for year 2, 1 lakh for year 4, and so on. So I've already made the payment of 4 lakh rupees in first of the 4 years. Now I'm only left with 1 lakh rupees as my principal balance outstanding at the end of year number 4. For fifth year, the interest will be calculated on that 1 lakh rupees, which will be 10% of it. That's gonna cost me 10,000 rupees. Now the final principal installment has to be made for fifth year, which is 1 lakh. Adding to it, I'll have to pay the interest, which is 10,000. So my total outflow, cash outflow, will be 1 lakh 10,000. Now, since again I need to take into consideration, which is the tax saving on depreciation and interest, I'll multiply this 1 lakh 1,000, 1 lakh 10,000 with 30% taxation rate. I'll get a figure of 33,000. I'll deduct the same from the total cash outflow. I'll get the net cash outflow of 77,000. I'll have to multiply the same with the present value interest rate factor for fifth year, which is 0.681. I'll get the total present value of cash outflow for fifth year as 52,437. Now, what we are supposed to do? We are supposed to add all these total present value of the 5 years. We'll get the figure, which is 3,67,647 rupees for all the present values of these respective 5 years. Now, since the salvage value which I'll get after the end of 5 years, this is something which will reduce my expenditure. So I'll decrease my present value of the inflows which I'll get with respect to the salvage value, which is 50,000 rupees. Multiply the same with the taxation rate, which is 30%. You'll get 15,000 as the tax saving over there. Decrease it from that 15,000, you'll get the final figure of 35,000. Multiply the same with the present value interest rate factor at the rate of 8% for fifth year, which is 0.681. 35,000 multiplied by 0.681, you'll get a figure of 23,835 rupees. Now you're required to subtract this particular present value of the salvage value. You'll get the present value of net cash outflows, which is 3,43,812 rupees. I hope guys you are clear, crystal clear with the kind of how to go about while solving this question with respect to borrowing option. Shall we proceed further guys in order to understand what are we supposed to do if in case we would have gone for an option which is leasing. So this is the one. Calculation of lease rentals. It is extremely easy for you guys to understand now. Required now, since in this particular question we have got this figure, which is the present value of the net cash outflow for the final figure is 3,43,812 rupees. Guys, this is the amount of expenditure which should be shed out of my pocket even if in case I go for leasing option. So this is the same amount which I'll take while calculating the lease rental amount. What should be my lease rental amount wherein I am indifferent to choose whether I should go for borrowing option or I should go for leasing option. So I'll take this amount of 3,43,812. I'll divide the same with the present value interest rate factor annuity at 8% for each of these cases. So I have prepared this table in order to make you understand with complete clarity as to how I was able to reach to a figure of 3.993. Guys, this is a table wherein I have dedicatedly made 4 columns: year, denominator, numerator, and present value interest rate factor. Year has to be 1, 2, 3, 4, 5. Denominator will change each year, guys. It has to be 1.08 for year number 1. I'll multiply the same with 1.08 for year number 2. I'll get a figure of final 1.17, and so on for year 3, 1.26, 1.36 for year 4, and 1.47 for year number 5. Numerator has to remain same, so I'll get the present value interest rate factor for each of these 5 years. I'll add up all of them. I'll get a figure of 3.993. So required annual after tax cash outflow will be 3,43,812 rupees divided by 3.993. I'll get a figure of rupees 86,104. This is the amount of lease rental that should be asked for each year in each year. But remember guys, since this is an amount which is basically net of taxes, okay, then what should be the gross amount which should be asked for in order to reach to a position wherein the company will be indifferent to choose for any of the option, be it borrowing or leasing. So the annual lease rental of 86,104 has to be divided from 0.7. Why? Because this is the figure which is net of taxes. So I'll get to reach to a position wherein I can calculate the gross figure, which would be rupees 1,23,006 rupees. Now this is what we are supposed to do in this particular question. I hope you guys are pretty much clear with each and everything which I told you up and made you understand in this question. Shall we proceed further with the next question, guys? Let's go ahead and solve it down. This question was again asked in CA final examination. It says Armada Leasing Company is considering a proposal to lease out a school bus. The bus can be purchased for rupees 5 lakhs and in turn be leased out at rupees 1.25 lakhs per year for 8 years with payments occurring at the end of each year. Remember guys, keep that in your note, keep that in your mind. All the payments have to be made at the end of each year. It has also provided us 3 different information. Number 1, what we are supposed to find out in this question. Number 1, we need to estimate the IRR, internal rate of return for the company, assuming that the tax is ignored. Secondly, we are supposed to provide them what should be the yearly lease payment charged by the company in order to earn 20% annual compounded rate of return before expenses and taxes. Number 3, calculate the annual lease rent required to be charged so as to amount to 20% of after tax annual compound rate of return based on the following assumptions. Assumption number 1 is tax rate is 40%. Assumption number 2, straight line depreciation has to be implied on it. Number 3, annual expenses of rupees 50,000 will be incurred each of the year. And lastly, the resale value will be rupees 1 lakh after the turn. We have also been provided that the present value factor for 20% return in totality is 3.837. This is something which has already been provided to us in the question itself. So guys, let's understand the question here itself and sum it down. The machine will be costing us rupees 5 lakh. If in case the company chooses to lease out the option, then they can get the same on a lease rental of 1.25 lakh per year for 8 years. And the payment has to be made at the end of each year. Now, what we are supposed to do, we are supposed to do and find basically the IRR for the company in part number 1. Also, they have asked us that what should be the yearly lease payment which needs to be charged by the company if in case they just want to earn 20% annual compounded rate of return before expenses and taxes. What should be their yearly lease payment in that particular case? And lastly, it says what should be the annual lease rental which is required to be charged so as to amount that 20% after tax annual compound rate is basically done. And they have provided us 4 different information starting from taxation rate which should be 40%. Also they have told us that the depreciation will be charged on equal rates, which is the straight line depreciation for all the 5 years. Also they have provided us that annual expenditure will be held and the same will gonna amount as 50,000 rupees for each of the year, and after a period of the complete 5 years the resale value will be 1 lakh rupees after that turn. So this is what we have been told to in this particular question, and we are supposed to find out each of these 3 different scenarios. Are we guys all set? Let's go ahead towards the solution. So guys, number 1 is the IRR of the company assuming that the tax is ignored. Guys, in this particular question which has been told to us that the cost of the machine is 5 lakh rupees, and since it's gonna be leased out at 1.25 lakh rupees per year for next 8 years. What is my payback period? Payback period is something wherein I come to a conclusion that by how much time will be my cost be recovered. So in this particular case, if I'll be spending 5 lakh rupees, then and I'm asking for a lease rental of 1.25 lakh each year. So by what time my initial investment will be repaid to me? So it's as simple as this thing, wherein 5 lakh rupees will be divided by 1.25 lakh rupees. I'll get the figure which is 4 years. By the next 4 years, I'll be able to take back my 5 lakh rupees which I have invested. After that 4 years, whatever I'll be getting, that will be a kind of a profit for me, which is a simple payback period. I'm not talking about discounted payback period here. I'm just considering payback period. So 5 lakhs divided by 1.25 lakh, I'll get a figure of 4. Now, the present value factor, if you take into the annuity table, you'll see which usually gets provided to you once you'll ask for the same in your examination hall. Present value factor which is closest to 4 in 8 years. It has been it's gonna be 4.078, and which will be applicable only at a percentage of 18%, which is an approximate thing. So therefore I can say that IRR will be 18% if in case you go for the first thing, wherein the payback period is 4. So the first question gets solved over here itself, wherein you can see that the estimation of IRR for the company, assuming that the tax is ignored, calculate the payback period, which is gonna be in this particular case 5 lakh divided by 1.25. You will get a payback period of 4 years. Identify 4 years in your annuity table, basically 4 in your annuity table for 8th year. So you will get 4.078 as the nearest decimal. So that will be applicable at 18%. So therefore I can say that the IRR is gonna be 18% approximately. Now coming to the question again, which says what should be the yearly lease payment which should be charged by the company in order to earn 20% annual compounded rate of return before expenses or taxes. Now guys, desired lease rental to earn 20% IRR before expenses and taxes. Again, it's gonna be a very simple affair. We are supposed to provide and take into consideration the cost of the asset, which is 5 lakh rupees. Divide the same with present value interest rate factor for 8 years at 20% rate. You will get a figure of 3.837 as their summation of present value interest rate factor annuity. 5 lakh should be divided by 3.837. You will get a figure of rupees 1,30,310 rupees per annum. This is gonna be your desired lease rent. So if I'll talk about with the same in comparison with what has been stated to us in the question, it has been stated to us in the question that the equipment will be leased out, that the school bus will be leased out at 1.25 lakh lease rental per year. But if in case we need to earn a 20% annual compounded rate of return before expenses and taxes, then in that case I'll have to charge 1,30,000 rupees at least in order to get to that figure. This is what this question has stated to us. Now coming to the third part, which says calculate the annual lease rent which is required to be charged so as to amount to 20% after tax annual compound rate of return based on the following assumption. Assumption number 1, 40% taxation rate, straight line depreciation, annual expenses of 50,000 rupees and resale value of 1 lakh after the turn. Now how to go about and solve this question? We need to understand an equation. Okay guys, now what this equation is basically all about: present value interest rate factor for the next 5 years, for basically in the next 8 years at 20% annuity. We have calculated the same in second part itself, which is 3.837. You need to keep it in your LHS. Now what we are supposed to do is basically we need to find out the cash outflow, which is gonna be my figure number X. Now this is gonna be my profit, which is X. Earning minus expenditure, which is regular one, that is 50,000 rupees. Apart from that, you also need to deduct your depreciation out of it. Then you'll subtract 50,000 again from X. Multiply the same with 1 minus tax, that is your net tax inflow. So 1 minus 0.4. Now since your depreciation is your non-cash expense, so it has to be again added back to the equation, which will be plus 50,000 rupees. Apart from this, we have been told to us in the question itself that the salvage value will also be provided, which is after the turn of 8 years. So 1 lakh multiplied by 8th year's present value interest rate factor, which is gonna be 0.233. So once you will be like adding all these things together, you will have to check that your cash outflow, which has been available to us in the question itself, which is 5 lakh rupees, it has to be exactly the same amount. So you will get a figure wherein you can see that what amount you should charge from your lessee so that your cash outflow is equal to that particular lease rental amount. So in this particular case, it will come as rupees 2,23,729. What am I supposed to do? I am basically doing here that 223,000 rupees, I'll deduct expense of 50,000 rupees, which is likely to be expensed off each year. Also, I'll deduct my depreciation, which will be charged. This will be multiplied with my taxation rate. So balance will be my net cash inflow in that particular case. Also, since depreciation is a non-cash deductible expense, I'll have to add it back to that particular amount. Also, then I'll have to take into account which is the salvage value. It comes out to be 1 lakh rupees. Multiply the same with your present value interest rate factor for 8th year, which is 0.233. That entire amount will be equal to rupees 5 lakh rupees, which is the cash outflow. You'll get the figure of rupees 2,23,729 rupees. I hope you guys are clear with this question itself. Perfect. In the first part, we have calculated payback period. In the next part, we have got the desired lease rent if in case we need to reach to a figure of 20% IRR before expenses or taxes. And also if in case this position is basically revised with the help of a few expenditure, depreciation and salvage value taken into account, then what should be my lease rental? So it has to be 2,23,729 in the third case. Clear, guys? If in case you have liked our video, if in case you found it useful, and if in case you have found it worth knowledge sharing, do share it with your friends. Sharing is caring, guys, and certainly do keep watching our videos. I'll say thank you on behalf of the Edupedia World. I am still remaining with one more presentation where I'll discuss a few more relevant questions which have already been asked in CA final examinations. So stay tuned. The chapter is not yet over. Post this chapter will mark the beginning of one of our fascinating topics, which is the Forex. So keep interacting with our questions and queries, guys. Keep pouring your love. If in case you found this video useful, do give us positive comments. Definitely your love is much appreciated and acknowledged for. Stay connected. I'll see you in the next presentation. Till then, God bless you. Sayonara. Bye.